Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of June 23rd. I want to start by thanking everybody for joining us this week. I want to remind you to go ahead and like and subscribe to the video and the channel if you're enjoying the content or find it helpful. And if you know anybody else that you think would actually enjoy or benefit from our content, feel free to share that and bring them into the loop. So with that said, as usual, my goal is to use my background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. So with that said, let's get ready to hit the books and get up to speed on the markets. As we usually do, we'll start this week's video with taking a look back at last week. Last week, we had two interesting developments as far as tariffs and trade policy are concerned. The first was that the Trump administration announced that quote-unquote derivative products, meaning things made with steel and aluminum, like auto parts and home appliances, would be included in the 50% tariff on steel and aluminum that's already been put into place. The second development, of course, was that the Trump administration reiterated the fact that in the very near future, we should expect to see additional tariffs on products like pharmaceuticals, semiconductors, and critical minerals. So as usual, the waiting and the uncertainty continues as we wait to see what those tariffs are, how big they are, and how long they stick around. The biggest headline grabber for last week was, of course, the Federal Reserve and the Federal Open Market Committee deciding not to change interest rates for another 6 weeks. Ultimately, they'll meet again at the end of July, but for now, the Federal Reserve feels that they are in a good position to respond to either inflation or economic slowdown with their current interest rate policy. The other interesting aspect of this month's meeting was we saw the summary of economic projections, which ultimately asks all the members of the FOMC board to make a projection for where they think inflation, unemployment, and the economy will be moving forward over the next couple of years. The interesting result of these new projections were that we saw the same number of projected rate cuts, 2 interest rate cuts for the rest of 2025, but we saw several more members move their decision or their projection to 0 interest rate cuts. We also saw an increase in what we would call stagflationary effects, including inflation expectations rising to 3%, unemployment expectations rising to 4.5%, and economic growth falling to 1.4%, all estimated by the end of 2025. The big takeaway from the summary of economic projections was that the Federal Reserve is expecting more of a stagflationary environment. Ultimately, what they're projecting is that as a result of ongoing tariffs, increasing oil prices because of the conflict in the Middle East, and mass deportations, which is also a stagflationary supply shock, the possibility that we'll see increased inflation as well as economic slowdown at the same time, in their mind has increased, although not to dangerous or catastrophic levels. Taking a look at some of the other economic data from last week, we saw retail sales fall, business inventories flat, and industrial production decrease, all within the month of May. Ultimately, these 3 data points suggest that we continue to see ongoing uncertainty among consumers, businesses, and in the manufacturing sector. The National Association of Home Builders also released their housing market index last week, Unfortunately, the index value fell to the lowest level we've seen since 2022. We saw that the number of new building permits in the month of May decreased by 2%. The number of new housing starts in the month of May decreased by about 10%. But within those numbers, we saw the number of single-family housing starts increase slightly. Ultimately, there are growing and ongoing concerns within the housing market. Specifically, home builders are concerned about increased costs as a result of tariffs and reduced demand as a result of higher interest rates and lack of overall affordability. Last of all, on the economic side, we saw the monthly leading economic indicators report out of the Conference Board. And unfortunately, the index fell slightly in the month of May, following a significant drop in the month of April. Ultimately, what we saw in the data for the index was that a rise in the S&P 500 and the stock markets throughout the month of May was offset by ongoing consumer pessimism, weakness in manufacturing and housing, and significant increases in the initial unemployment insurance claims. Turning our attention to the stock market, unfortunately, it was a tough week in the markets last week. We saw all three major stock indices fall throughout the week. The ongoing concern and uncertainty about conflict in the Middle East, combined with what some perceived as weakness or at least mixed results in the economic data this week, ultimately caused investors to hold back and potentially pause some of the upward movement we've seen recently. Last week, we saw very little movement in the market for the 10-year Treasury, as the 10-year Treasury yield dropped early on in the week, recovered the majority of the loss by the middle of the week, and then dropped again, ultimately to end the week around 4.35%, which isn't very different from where we've seen it historically over the last few weeks. But it just seems that the bond market and bond investors are reacting briefly to headlines and ultimately ending the week about in the same place that they started, as the major uncertainty and major unknowns in the economy just simply haven't been answered yet. So as I usually do, we'll switch over and take a quick peek at the alternative markets. And of course, I have to start this week talking about crude oil. The price of crude oil has increased now for 2 weeks in a row by a significant amount, in large part and almost entirely in response to the ongoing conflict between Israel and Iran. The two big questions that everyone is waiting to answer, the first of which is whether the United States will become directly involved in the conflict. The second of which has to do with the special geographical area known as the Strait of Hormuz. So this strait is a body of water in between the continents of the United Arab Emirates and Iran. It's a relatively small passageway, but 20% of the world's global oil supply flows through this passage at any given time. Ultimately, the concern, of course, is that should Iran choose to close that strait and to either limit or end the flow of sea traffic through the strait, this could cause a huge disruption to the global oil supply and could cause a significant and dramatic increase in the price of oil. Unfortunately, we've seen mixed signals from all of the interested parties, so we don't necessarily know how this is going to play out, but it is one thing that we will continue to watch along with crude oil investors moving forwards. Turning our attention to a couple other areas, we saw the value of the US dollar rise throughout the week, although only slightly. We saw the value of gold as a safe haven asset fall throughout the week, although only slightly. And we saw the price of Bitcoin increase significantly early in the week and then drop off pretty significantly towards the end of the week. Friday, we saw a pretty massive sell-off in Bitcoin as the markets attempted to adjust to current economic conditions. Looking ahead to this week, one of the first pieces we'll be watching this week is some retail earnings reports. Ultimately, we'll see earnings reports from Nike, Walgreens, General Mills, Carnival Cruises, and FedEx. All of these companies being major players in their respective industries, and all of these companies potentially offering some insight on consumer spending trends and habits and retail spending in the future. This week, we'll also see information on our consumer confidence and consumer sentiment reports. We've seen some slight improvement in the most recent reports, so the big question is whether that trend will continue, and if so, by how much. Also this week, we'll see the third and final revision to the first quarter gross domestic product for 2025. As a reminder, this report showed that the U.S. economy shrank by 0.2% in the first quarter. So all eyes are on this revision to see if it revises up or down, or if we end up ultimately in the same place. Last of all, this week we'll also see some important information on inflation. The Personal Consumption Expenditures Index will be released later this week. The PCE report not only gives us the PCE price index, which we think of as the Federal Reserve's preferred inflation gauge, but it also gives us information on personal income and personal expenditure, which could reveal a little bit of information on the previous month, how consumers were earning and spending their income. Wrapping up the headline economic data for this week, we'll again see our weekly unemployment insurance claims on Thursday. Ultimately, we've seen a significant increase in both initial and continuing claims. So the big question among analysts is whether this increase will continue or if we will see some recent reversion back to the levels we've seen over the last few months, and the implications this may have for overall economic slowdown. Some of the other economic data we'll see this week that may or may not make headlines. We'll see reports on pending, existing, and new home sales, as well as home prices for the previous month. We'll also see information on retail and wholesale inventories, as well as additional information on our trade deficit in goods for the month of June. And wrapping up the week, we'll see a report on durable goods manufacturing. Looking a little further into the future, as has been the case for several months now, uncertainty and economic anxiety is the name of the game. It looks as though the Federal Reserve continues to remain in a wait-and-see posture, as do consumers and businesses and our trade partners. The reality is that there are just a lot of big questions and not a lot of big answers still. So as we move through the rest of the summer, it looks as though some of the ongoing questions will be focused on tariffs, protests, of course, conflict in the Middle East and Ukraine, as well as ongoing debates about big, beautiful bills and increases in the federal deficit and the national debt. So as we move forwards, we're going to do our best to capture all the information we can, distill it, and bring it to you in an easy-to-understand format, just capturing the headlines and the major takeaways. I want to thank you for taking the time to join us this week, and I want to encourage you to check us out again in next week's video. Thanks, and we'll see you in about a week.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.